Thanks for joining us for the earnings call of Mahindra CIE Automotive Ltd. From the management side today, we are represented by Mr. Hemant Luthra, Chairman of the company, Mr. Ander Alvarez, CEO, Mr. K. Jayaprakash, the Chief Financial Officer, and Mr. Vikas Sinha, Senior Vice President Strategy. I would now like to hand over the call to the management for their initial remarks. Over to you, sir.
Good morning, everybody. This is Hemant Luthra. There's not much for me to say since all of you have seen the results, and there's no point gilding the lily, and therefore all that I'm going to say is my pleasure to be part of this team, and my pleasure to depend on people who are far better than myself to deliver the results that I think shareholders are looking for. So I'll just hand over to Vikas, and I'll come in at the end. If there are questions, feel free to direct them to the CFO. JP is here. Orwitz from Spain is also here. Vikas is here, who heads our investor relations, and Ander is here. So feel free to direct the questions, and then I'll come in at the end. I don't think I need to say much more here, except we're very, very pleased with what's going on. Vikas?
Yeah, good morning, folks. I will present the MCI results for the first quarter of CY18. We will start with the India results on page 4. Now, India had an excellent performance in first quarter in both revenue and profitability terms. The EBITDA for the India business has breached the 15% EBITDA mark, which is good news for us. The EBITDA has thus grown by 49% versus first quarter CY17, EBIT by 71% and EBT by 88%. The sequential comparison versus previous quarter is even better, showing consistent growth in both revenue and profitability. Do keep in mind that the previous quarter was depressed by one-time VRS and other provisions, which we had talked about in our last call. The India business has grown by 24%. All divisions in India have seen healthy growth. The main drivers of our growth in India have been the positive market evolution in UV, tractors and two-wheelers, as well as the growth at some of our key customers. The revenue growth has also been augmented by favorable raw material and scrap prices. Based on the overall economic indicators in India and the normal forecast for the monsoon this year, we remain optimistic about our performance in next quarters. Our European results are shown on page 5. Sales have grown by 26% vis-a-vis Q1 C17. 10% of this growth is on account of positive exchange rate translation impact. We have managed to maintain EBITDA margins as compared to Q1 C17. In absolute terms, EBITDA has grown 27% versus Q1 C17, EBIT by 35% and EBT by 46%. The sequential comparison versus previous quarter shows a decline on an absolute as well as margin basis. As explained by Ander in the previous results call, the EBITDA in Q4 C17 was inflated due to retrospective price increase and the reversal of the provision made for the year-on inventory results. The quarter's EBITDA is also negatively affected by the steel price increase agreed to by customers but yet not received from them. We are also confident about the evolution of our results in Europe in the next quarters as both the market and our internal operations are solid. And now, if we go to slide 6, we'll see the consolidated results, which are a combination of the positive evolution in both India and Europe. 26% growth in revenue, 36% growth in EBITDA, 50% growth in EBIT, and 62% growth in EBT when compared with the same quarter of last year. The consolidated EBITDA margin is at 13.8% for QYC18 compared to 12.8% in QYC17. Q1 C17. The decline compared to the previous quarter is due to the effect of one-time provisions that we referred earlier. With that, we can now proceed with Q&A, and I hand it over back to Nishant.
Nishant, just 1 second. This is back. Hemant Luthra jumping back in. Gentlemen and ladies, on the presentation that has been uploaded to the site, our team has been working very hard. Please note that there's a typo on the first page. It should be 19th April 2018 and not 19th March 2018. We'll have it corrected. Back to the question and answer. My apologies on behalf of the team for that correction, for that error.
Thank you very much. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Not sitting in the same.
We take the first question from the line of Ashi Anand from Allegro Capital. Please go ahead.
Oh, yes, hi, thanks for the opportunity. The first question is with relation to the margin expansion in India. Just wanted to understand what were the key drivers of the margin expansion and sustainability of the same going forward.
Sorry, could you repeat your name, please?
Yeah, my name is Ashi Anand from Allegro Capital.
Allegro, okay. Ashi Anand, Allegro.
Ander, would you like to take this? Basically, why did the margins in India increase and whether it is sustainable?
Okay. Yes, I'm pleased to answer to this question. Okay. During all these, let's say, last 2 years, we have been working very hard in order to improve our internal efficiencies in each and all of the different divisions that we have in India. Okay. This work and let's say this focus on efficiency and internal improvements is now paying the results. Okay, we have, let's say, 2 main effects also to have this huge increase in the margins. Of course, one of them is the volume increase that we have had in all the divisions. That is a very good news, and that helps us a lot to leverage this margin increase. But on the other hand, we have these new technology implementations, efficiency improvement actions that we are working very hard. I would say that the most performing technologies were casting technology and also gears and forging. They are doing excellent job. We are increasing our output. I mean, I can tell you that this first quarter, this Q1 2018, has been the most productive quarter in the history of our companies. I mean, the production in our castings per month, when we used to be about 3,500 tons, we overpassed the 4,000 tons, and the same situation in the forging. So I would say that there are 2 main drivers, volume increase and internal efficiency improvement, and we are now matching and gaining the trust and the confidence of our customers, because now we are becoming a real, reliable and excellent quality company. That's our task, and the market is recognizing that. Okay.
Okay, excellent. Congratulations on a great job. The second question was with relation to Europe. If we look at European growth, even if you adjust for the currency impact, it's about a 16% growth. Now, you had mentioned in the last quarter that part of this growth was being driven by new business wins in Metal Castello and the Lithuania plant. Just wanted some kind of an understanding on what's the outlook on kind of European growth, one for this year, and if you're looking at it from a 2-3 year perspective on a constant currency basis.
Okay. In Europe, as you saw and as Vikas explained in the presentation, the growth, let's say, is helped, and let's say we have the positive impact of the exchange rate that means approximately 10%. So the real, let's say, real organic growth in euros, as we are checking that in Europe, is approximately 16%. Okay, 16. That means that we are far above the market. Okay, and especially Metal Castello is growing at a tremendous pace, mainly because you know that we mentioned here that we got this big new program coming from our customer Caterpillar, that we were making all the industrialization during last year, and we have already started the production. Okay, so the jump in Metal Castello was, I can give you the exact data, that 45% growth in Metal Castello in first quarter of 2018. Okay, our forgings are also growing at a good pace, and in Mahindra, even Mahindra forging, let's say MFE, let's say our German forging that you know that we have been struggling during the last years to make a profitable business from that companies. Now we are at a growth with a growth of approximately 10%. Okay, so overall you can see that the growth is coming from all the different verticals that we have in Europe, and of course the higher growth is coming from Metal Castello due to this new program that is now starting the SOP, and I can say you that we are getting the ramp up, so the growth should continue, let's say, continue in the next quarters.
No, just to add to what Ander has said, the long-term growth will be closer to the market growth. That is something that you have to bear in mind. This, as we said, is the ramp-up period of the two new businesses that you have mentioned. So keep in mind that the long-term growth will be closer to the market growth, which in Europe would be lower than what has happened this quarter.
Yeah. Okay, excellent. Thanks for all the answers, and congratulations once again on a good quarter.
Thank you very much.
Thank you. We take the next question from the line of Nitesh Sharma from PhillipCapital. Please go ahead.
Good morning, everyone. Congrats on a good set of numbers. Sir, to begin with, on the India business, we've seen a strong revenue growth traction much ahead of what our key clients have grown. So can you help us strip off the impact of RM cost passing off to the end customer in the revenue?
Yeah, JP, will you take this? So we have seen a 24% growth in the India business. I would think somewhere around 3 to 4% would be because of the steel price increase. The rest would be all organic and volume.
Okay. And is there any impending rate hike in India which would come in the subsequent quarters?
The rate hike?
RM price
hike, yeah.
See, the price for steel is increasing every month, so it would come in, I would think, because I don't think the steel price will still settle.
So in Q1 itself, we saw some gross margin pressure, almost 400 bips to 500 bips margin pressure on the gross level. So do you think this would revert to some extent in the coming quarters?
You are looking at the raw material price jump, the percentage going up, right?
Right.
No, as of now, the steel scene looks difficult, so I don't think there's going to be any immediate production.
Okay. And can you help us update on the Mexico plant? What is the status? Where are we in utilization, and how is the ramp-up going on?
I think, Ander,
will you just take this?
Yes, I can explain the situation. The ramp-up is going on, let's say, according to the plan that we have with our customer in Mexico. What is true is that as it is a new factory, new machinery, new people, we have some difficulties to cope with the demand, and let's say that we have a lot of pressure in that plant. However, let's say we have now, and this week we have our best forging technicians from Europe and from Mexico, that we have also a forging plant in Mexico. They are supporting Vilforge because during the next 2 quarters, the production will double. Okay, so we need to be ready to continue with the ramp-up. On top of that, we received and we were nominated for a new program for another customer. We set up one new press in Mexico. All these feedback procedures, the sample production and everything has been done and has been approved by the customer, and the SOP will be January 2019. Okay, so in approximately 9 months or 8 months, we will start the production with another customer. So let's say that the expectations on these plants are very, very high. And just for to give you also an additional information is that with this second press, we still have limitations to cope with the forecasted demand from customers. So we will probably by the end of this year we will add an additional third press to continue with the growth. So the expectations in Mexico are really, really excellent. The only point is that, okay, this is a new factory and the inefficiencies coming from this factory, I mean the scrap rate and the OEE coming from the lines are not still at the required level or expected level. Okay, so that's where we are now working on with our best teams.
Got it, sir. Thank you. I'll come back in the queue.
Yeah. Thanks, Nitesh.
Thank you. We take the next question from the line of Ujjwal Shah from Quest Investment.
Yeah, thank you for taking my question, sir, and congrats on good set of numbers. Just wanted to understand that once the steel price increase is passed on in Europe, what will be the impact on the European margins for the next few quarters, so for the 9 months, for next 9 months?
Yeah, Oroids, can I request you to take this? Basically saying when the steel price increase comes in, what is going to be the likely impact over the full year in CY18 in Europe?
Yes. Yes, more or less in Europe, the total impact of not having received this steel price increase has been at about 1% on the EBITDA margin.
Sorry, I couldn't...
1% on the margin, there will be an impact.
1% on the margin.
Okay.
Yeah.
Coming to the Bilforge Mexico operation, so there is a note stating that we have around 10 odd crores of currency impact that came on account of this unit. Can you explain?
JP, will you take that?
A bit large.
Okay. So we have a loan in Mexico, which is in dollar denomination, and the local currency sending is what has resulted in this exchange gain.
Okay, sir. And lastly, Anders just mentioned that MFE has seen a growth of around 10 odd percent.
Yeah.
So have we won any new orders in that plant? Because 10% looks pretty decent growth for MFE business. So is it expected to continue at this rate for next 9 months?
Yeah. In MFE, let's say that right now the growth is 10%. The forecast that we have, let's say the orders coming from our customers show the same level of let's say this high demand in the next, let's say, 2-3 quarters. This growth is coming especially because all our customers, let's say most of them are European car truck makers, you know, the Scania, DAF, MAN, Daimler, and those companies, they are exporting a lot to the States. I mean, the truck business in the States is booming right now, okay? So we are supported by that. Okay? This is one of the explanations why we are receiving so many orders from the customers. Second impact is that, you know, this technology, it's quite mature technology, and some of our competitors are failing in the market, okay? So let's say there is a concentration in the biggest one, in the most reliable company. So we are getting benefit. We are recuperating part of the business coming from the non-performing companies or competitors. So with these two effects, right now the position is all our plants in Germany, the 3 of them, they are fully booked. And even when we receive additional orders, sometimes we have to refuse these orders because the capacity is fully booked. So let's say that the momentum is really, really good in Germany in this particular business. And the results in this first quarter, as Vikas explained, were negatively affected by the steel price increase. Last year, the steel price increase in 2017, the steel price went up something like 25 to 30 euros per ton. That was the growth. And we succeed in, let's say, passing through this increase to the customers at the end of the year. Okay, that's why the Q4 was excellent, because we were paid retroactively from 1st of January. Okay,
right.
This year the growth in 2018, the growth is huge. I mean, it's about 100 euros per ton. So let's say all the suppliers, we are going to the customers absolutely aggressively, because we cannot bear 100 euros per ton more than 3-4 months. Okay,
right.
So right now we have already closed most of the agreements, not 100% of them, but most of the agreements are already closed, and we are going to start recuperating this amount of the steel price increase. We are going to recuperate approximately this 1% that already explained during the Q2 and Q3. Okay, so we will have a positive impact coming from that effect in the next quarters.
Great, sir. Thank you. And lastly, you mentioned about Billboard Mexico ramping up so well. So based on our expectations, once the 3 presses are all up and running, what is the peak revenue expected out of Billboard Mexico operations? If you can give some idea.
Yeah, we could expect $30 million more or less. Okay, so that's $35 million. That's as far as with the orders we have now, that's the amount that we expect to reach by the end of next year. Let's say we will start the ramp up of the new customer project beginning next year. The ramp up of our current existing customer will be at the peak volumes by the end of this year. So let's say in 18 months, more or less, we will reach approximately that level. Yeah.
So that would be the run rate. It won't be the full year number.
What is the run rate in Mexico?
13. So what would be the full year number? The run rate, this means per quarter, or?
Yeah.
30 annualized. No?
30 million is annualized.
Annualized, right?
Yeah.
Okay.
Annualized, yes.
Okay.
30 million annualized, but at a run rate level at the end of the next year.
Yeah, got your point.
That's right.
Thank you.
Because we are in a ramp up, okay?
Yeah, thanks a lot.
Thank you. We take the next question from the line of Sunil Kothari from Unique Investment. Please go ahead.
Yeah, thank you very much, sir. Congratulations for a very good performance. Sir, I have 2 questions. Basically, we are now reaching a revenue size of roughly 1,900 crore per quarter consolidated, and Europe 1,100 plus and 700 plus India. When, if this demand trend continues, this steady demand and little bit growth, where you feel you will have a capacity constraint?
Okay. Regarding, let's say that our capacity constraints, in Germany, as you know, it's a non really profitable business. I mean, it's below our standards. We don't plan to continue investing there. I mean, we are only making maintenance capex in our German operations. Okay, and the idea is to fulfill the capacity, maximize the results, and do not invest in development in those companies. Okay. On the other hand, let's say in India, we are investing heavily to solve these bottlenecks in terms of production to continue growing. Okay, so you can see that the last year we made an investment approximately 3,000 million rupees. I mean 300 crore. For this year, we expect to go to up to 400 crore of investments. And the idea is to continue adding capacity. We are even advancing, as the gear business is fully booked right now, we are advancing 2019 investments to 2018. So we are moving ahead the investments. The forgings in Guildford, for example, we are adding also a couple of presses in order to continue with the, let's say, supplying to the customers, that they are increasing the demand. So we are growing in, let's say, adding new capacity in all the profitable businesses where we have, let's say, the customer demand. That's where we are. So we are really happy that we are investing in the high-tech technology. We are adding robotized cells. Let's say that we are moving in the right direction regarding technology and capacity. So that's my explanation how we are going to cope with the demand, is adding capacity where we need it.
Okay. So currently we don't face any capacity constraints at this run rate.
Okay. What we have done certain capacity constraints in Mexico, for example, but because of some operational problems, let's say like that, those are being solved, and we will release these bottlenecks, and we will continue in production. Internally, we don't have now any blocking point in the company, but we need to be prepared for the new forecast that we are receiving from the customers. Okay, you need to also understand, and because we were yesterday analyzing this deeply, and in the board of directors, why we are having this success. And my point was very, very clear. I mean, as we are now a reliable supplier with the excellent delivery performance and excellent quality performance, we are consolidating the production from other competitors, and the customers are trusting us. So that's mainly the key of the success that we are having, especially in India.
Great, sir. And my last question is, sir, we have some objective to achieve some EBITDA margin and EBIT margin. So that process is continuing, and will we see some improvement in current year consolidated margin?
Okay, that's my job. Yeah, I have this pressure from the shareholders, and I have this pressure from, let's say, from CIE to reach the standards that CIE has in let's say Europe and worldwide, and we are in the way to get it. Okay. Yes, my expectations is that we should continue improving. Yes.
Great. Sure. Thank you very much, and wish you good luck.
Thanks, Sunil.
Thank you very much.
Thank you. We take the next question from the line of Pratik Poddar from ICICI Prudential. Please go ahead.
Hello. Am I audible?
Yeah, hi, Pratik.
Yeah, hi. Sir, just one question on the India part. You talked, I mean, if I look at your key customers, their growth is almost 12%. 4% is explained by the steel cost inflation. The rest is explained by what? Is it that the other key customers have grown faster than the industry, or market share wins? Could you just talk a bit?
No. If you refer to page 4, and on that page 4 of our investor presentation, and we have given a market update table. Below that, we have given a note on our key customers. So if you look at the weighted average growth, I'm saying the weighted average growth of our key customers, then that would be about 18.5%. So I'll just read that out. The growth of MCI's customers weighted as per their share of business in MCI India for January to March 2018 is 18.5, and sequential growth is 15.7. So that's the, if I weight it as per what my customer buys, then that is the result. So we have given you that. Over and above that, 3 to 4% is raw material increase, which JP has pointed out, and the rest obviously is from some of the new additions that we have talked about in the past.
Okay, thank you. I missed that part. I'm very sorry. Thank you.
No. It's in a little small font, but nevertheless, we try to give that out every result.
Thank you. We take the next question from the line of Arvind Joshi from Battalion Advisors. Please go ahead.
Yeah, hi. Congratulations on the great job you guys have been doing since the last several quarters. I had a query regarding our announcement which we had made around the Bilforge acquisition, where we had intended we would be doing another QIP to fund our future growth. But now, looking at the kind of serious cash flows that are visible now, do you think QIP is gradually becoming redundant unless a exceptionally good deal comes along for acquisition?
This is Hemant Luthra. I would say that our focus is on ROE. Okay. And as you rightly point out, the balance sheet is strong, the cash flow is strong. Okay. And we are evaluating different options. and one of the options could be to resort to debt. Okay, and so I'm not going to comment on whether the QIP is redundant or not, okay, but it doesn't look necessary.
Thank you. Thanks and all the best. Thanks.
Thank you. We take the next question from the line of Jinesh Gandhi from Motilal Oswal Securities.
Hello?
Yeah, Jinesh.
Hi, congratulations on a great set of numbers. First question pertains to India business. So we have seen this reasonably high swing in our RM cost as percentage of sales, which might not be the right way to look at it, but given the limited understanding we have on this side, how do we
say reasonably high swing in RM cost? You're looking at the standalone numbers?
Standalone numbers, yeah.
Yeah, okay. JP. So the question that he's asking is on the standalone numbers, there is a high swing on the RM cost.
Is it something to do with mix? Is it something to do with a proportion of outsourcing versus captive manufacturing, or is it just RM commodity-led timing difference of pass-through?
So you are referring to that number in the SEBI report from 29358 to 34319? Is that what you are referring to?
Yeah.
So basically, it has to do with the commodity price increase.
Okay.
And the larger proportion of stamping, which has a higher raw material cost. So it's largely to do with the commodity price and the mix.
Okay. Mix is one part. Secondly, the India business growth of 18.5% for our key customers on the weighted average basis, this would be broadly similar across our main businesses, forging, stampings, castings.
No, this is a consolidated view.
But would some businesses would have grown faster than others because of...
No, that Ander pointed out in his initial remarks, if you remember, that gears, castings and forgings have grown quite well, and also bill forge.
Yes, I would say the casting, forgings and bill forge are the best performing or the fastest growing divisions, but the others, let's say the others are also growing above double digit. So let's say that it's quite balanced, the growth.
Right. Got it. Secondly, can you update on India business? Are there any new order wins which we have seen, either in terms of new customers or new products for existing customers?
No, we have talked about, Jinesh, we have talked about some of the new wins in the past in the highlights of the last year's calendar year investor presentation. We had talked about two of those customers in Ashok Leyland and TDK. We have further got some wins, but they will start materializing only in 2019. So we have not mentioned it in this quarter's investor presentation, but we have got orders from Kia and Hyundai for in the foundry and forgings, respectively. So we have got that, but it will have no impact on this calendar year. It will have an impact only next calendar year.
Okay, and are these sizable orders in the sense?
The question is, how do you define sizable?
So in the sense, do we have large share of business?
No, one of them is certainly very sizable. The other one is, of course, an entry point, so we are looking at it. As we come closer to that, then we will be in a better position to talk about, what is the size of the order. But we are excited about these two orders.
Sure. I mean, both are very big customers that way. Understood. And lastly, on European business margins, so if I've understood it correctly, the effect of RM cost would have been just about 20% on margins in this quarter. Is that right?
JP, what is the RM to sales in Europe this quarter? Is the question.
Impact on margins of commodity price is about 100 basis points.
No, we said in the Europe growth, about 2% would be because of the commodity price change. So out of the 26%, 10% would be currency related and 2% would be the commodity price related. So volume growth, you could take it as 14%.
Okay. And so EBITDA margin, the pressure which we have seen in this quarter vis-a-vis fourth quarter, despite sharp increase in revenues on QOQ basis, How do we read that?
Jinesh, we explained in Q4 of last year, we had two extraordinary items. One was we had the price increase, 68 million rupees, which we had got for the entire calendar year, which was put under Q4. So 51 million out of that was one time, and also there was this write back of inventory provisioning. If you had taken those away, I don't think there is any drop in.
There is still a drop, which is explained by the commodity price increase, which will come later.
Yeah.
Future commodity price increase will be about 1%.
Yes.
The impact would be around that.
Yes.
Yeah.
Understood. And lastly, in European business, this 10% euro growth which we have seen, almost 10% is similar for MSE. So other businesses also have grown in the same line because the European car business per se has been fairly weak as such. Car volumes have been fairly weak.
Yeah. Let's say that we have in Europe, we explained the German business, I mean the MSV that I explained before. Then I explained also Metal Castello's growth, that that is getting this new order, huge order of about 20 million euros coming from Caterpillar, and this project is in ramp up, so we will continue growing in Metal Castello. And finally, let's say, automotive or car forgings that we produce in our, let's say, previously CIE forgings, we continue growing because our activity in Lithuania, let's say in the east of Europe, we have this company where we invested in a couple of presses during the last year, and we are now ramping up this presses. So that's the reason of the growth. Let's say that, as I told you before, in Europe, the forging companies, all this sector has been suffering a lot during the last years, and there is a consolidation. So the best performing companies are consolidating and getting the businesses from the others, the low performers. So we see that we are a winner, a company in consolidating this business in Europe. So let's say that we expect to continue growing in the next quarters.
Understood. And given this phase of consolidation has started in Europe on the forging side, are we looking to acquire anything on the forging businesses in Europe?
Okay. We don't want to add. Let's say that as we told you that let's say it depends on the profitability and the strategic fit that this company could have with us. Okay, if let's say most of these companies that are in the market and they are struggling, they have very old machinery, very, let's say, poor maintained machinery, non-competitive structures. We are not willing to add more forging companies to our portfolio. No, what we want to do is we want to add their products and produce in our own assets. That means that we want to consolidate the production in our plants, and so we can maximize the profit from this business.
Okay, understood. Great, thanks and all the best. I'll come back in queue.
Thank you.
Thank you. We take the next question from the line of Shyam Sundar Sriram from Sundaram Capital. Please go ahead.
Hi, thanks for the opportunity. Sir, you had mentioned in the presentation of exchange rate effect of about 107 million in BF Mexico that has come in the PBT level in India, NCI India. Is it at the PBT level or should be it's not at the EBITDA level, right?
No, it's at the PBT level.
Okay. And, sorry, Ander also mentioned about new order win at BF Mexico. Is it in addition to the earlier two orders that we had already were talking about, or?
Ander, the question is the new order that we are talking about, is it the same as the second order that we had talked about earlier, or is it a third?
Yes. It's the same one, yes. It's the second customer we have, yes, there, yes.
Okay. My last question is in Europe. I mean, this point was raised by an earlier analyst. Given diesel backlash that's happening, of course, Ander alluded that there's a vendor consolidation that's happening. Generally, for your key customers, such as Renault, what is the outlook there, and what is the way forward on that front?
Shyam, of course, I'll ask Ander to add on to this. But the fact is, our customers are equally present in both petrol and diesel. So whatever happens, we will just follow them. So for us, it's not a problem at all. Of course, both Renault and Volkswagen have diesel portfolio, but they are also accordingly changing. And we don't have any preference of either diesel or gasoline in Europe. So that is not a problem for us. Ander?
No, not at all. Yeah. Yes, you are right, because I mean the point is that and it's true that certain diesel crankshafts or certain diesel components are being reduced, but at the same time, the gasoline ones are booming, okay? So in the balance, we expect to continue growing. I mean, our position, because we have analyzed this deeply, but according to our figures in the forging divisions, this impact will be positive for us because we are positioned in the fastest growing engines that we have in Europe in terms of gasoline. I mean, Renault is trying to put capacity, and it's doubling the capacity in the H4 and H5 engines, and we are the suppliers of this platform, of these engines. So let's say that the impact that we will have with the reduction of the K9, that is the diesel engine, will be offset and will be, let's say, overcome by this H4, H5 engine increase. So we are not affected in that, let's say, due to that effect.
Okay. Thanks a lot. That's it from my side.
Yeah, thanks, Shyam.
Thank you. We take the next question from the line of Priya Ranjan from Systematic Shares.
Yeah, thanks for taking my question. My question is related to what will be the contribution of this greenfield of Lithuania in the overall growth? And when we talk about 10% growth in MFE and 45% in metal castle, was it in constant currency?
Royce, can I request you to answer this question? So first question is, how much of revenues are coming from the Lithuania crankshaft business?
Yeah.
And second question is, what was the euro term growth in metal castle?
Yeah. Yes, the Lithuanian crankshaft business growth is something like 15 million euros. Okay, this is 15 million euros. This is the growth that are coming from there.
Annualized.
Okay.
Annualized. Yeah. And regarding the growth, the real increase in Castello, excluding the exchange rate impact, has been 35%.
35%.
35%.
Yeah.
Yes.
35%. Yeah.
So and MFE will be, say, the flat if we take the constant currency.
Annualized.
For this quarter. MFE cannot be constant.
No.
Yeah.
MFE is growing 10%. 10%, yes. The real growing in production. In euros, it's 10%. It's 35 in Metal Castello and something like 16% in the current passenger forklifts.
Okay. And sir, on India business, when we talk about, growth of, we are barely, growing in line with our weighted average growth of the customer. So when we are planning to ramp up this gear plant ahead of the, 1 year prior to what was scheduled earlier. So what can be the outlook for the next year in terms of overall growth? Because I guess there will be certain new businesses, maybe from new customer or maybe from the existing customer.
Priyaranjan, so I would still say that we should take the weighted average growth of our customers plus something extra that would come from there. So some of our existing customers, like the two-wheeler business, the tractors business, the small commercial vehicles business, the Maruti business, these are growing exceedingly well. So therefore, the weighted average. So we are right now in a sweet spot as far as our customers are concerned. And plus, we have added new customers as we talked about. We talked about Ashok Leyland, TDK, now Hyundai, Kia. So this will add a further growth to us in India. So that's the way to look at it.
And what will be the growth of the bill forge in constant, excluding Mexico? If we exclude Mexico, because Mexico will be, I think, big fill for the current quarter.
So, no, bill forge has also grown 25% plus.
Okay. And sir, just one more last question on this JKN, Melrose acquisition of JKN. So what's your thought and what can be the impact for the company, if any?
Let's say we have had several contacts with management in JKN, and their expectation is in the short term, let's say the main changes will come from the top management positions, but they will not affect us. Operations will continue in the same way. There is, in my opinion, there can be a positive effect for us or for all the suppliers, because you know that GKN, they buy millions of components to suppliers, but they produce also millions of components internally. Okay, so let's say that we are suppliers. They are our customers, but they are also our competitors in some way. Okay, and I'm sure that with the new policy coming from the new shareholders, they will reduce the investment in the production of the machinery that is, is massive in capital investment, and they will concentrate on the technology, and they will concentrate in the design and in the assembly of the components. I mean, that's the main concern that the shareholders of GKN had with the previous owners. Okay, they were spending a lot of cash, so there was no cash for the shareholder. So, in my opinion, if this is how the new shareholder sees the business, we will probably see an increase in our potential business with GKN. So let's say that we are not worried. I mean, and we hope they will solve everything properly, and they will continue being a market leader as an excellent company that they are.
So, and when we talk about Caterpillar order for metal caster, so I mean now the incremental whatever order has already come, or I mean we can expect more from Caterpillar in metal caster going forward also.
Yeah, the SOP of this program has already started. That's why we had this. Let me eliminate the foreign impact. I mean, this is 35% growth this quarter, and we expect to continue growing even more. Okay, because we have just started with these programs. The Caterpillar strategy was explained to us, and it was very clear that they don't want to invest any more in the production of the components. They want to work in the design and in the assembly of the components, and the production they will outsource. Okay, and that's the reason of outsourcing big volume of components. And as we have, let's say, full trust from, let's say, Caterpillar management, they awarded us the big bunch of these outsourced components. So let's say that Caterpillar will continue growing. Okay, and on top of that, let's say that we are moving part of the production from Italy, as the new projects are coming to Italy. We are moving some of the production to India. Okay, so we are making a win-win agreement with Caterpillar, where some of the production is transferred, and we use our capacities in Italy and in India, and the customers get the benefit of the more competitive pricing in India. Okay, so let's say that we have an excellent relationship with the customer, and we are making a really interesting business case for both sides.
And one last question to JP. What was the net debt position in the first quarter then?
Similar to the end of the year.
Why, I mean, this EBITDA we are continuously growing, but we're not able to reduce debt. So where are...
So we are doing good amount of capital expenditure now, as was explained in various questions before. And the negative thing for this quarter, if one would think of, is the working capital impact of all these steel mills now, there's a capacity constraint and they are seeking price increase and better credit terms. And we are also required to keep inventory. So the absolute number.
So one more thing on the domestic business. I mean, we have seen a lot of demand for the truck axle, etc., because the number of axles is going up in trucks with the higher ton as well. Vehicle growing much faster. So can we tap some of the opportunity in the interim, say, in next 1 year, 2 year, when the heavy commercial vehicle side is going to be stronger?
So we'll have to check, which part of our business could have a look at that. Axles would mean the castings business, But in India, we of course can't make the forged axles, but of course on the differential side, the housings, etc., we can make, and we do make. So that will obviously have will have a positive impact. But axles in India we can't make.
Okay, thanks. That's all from me.
Thank you. We take the next question from the line of Mahesh Bendre from Karfi Stock. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, in the European operations, we have hit 140 million euro mark this quarter. So is this a number sustainable for next 3 quarters?
Yes, I think so. That's our intention, and even internally we are trying to improve them. Okay, so what we see is we are now in a consolidated situation. Let's say all the problems, quality, deliveries are already in the past. It's a complex business because now we are in the peak, but we expect to continue with the same trend, and even improving a little bit. Okay? Especially coming from the steel impact that we have to recover from the first quarter. We are penalized, as I explained before, with 1% approximately, so we expect to recuperate this negative impact for the next quarter. So that will improve a little bit the margins.
Sure. And sir, just wanted to know how many plants we have in Europe and India, and out of those plants, is there any further scope for improvement, or do you think that the most of the plants that we are currently operating is stabilized in terms of efficiency?
No, we have 29 plants in all. Of course, in Europe we would have, 9 plants and 20 in India.
Yes.
So, except for our German and UK operations, all plants are in good shape. Even the German operations are fairly stabilized, but they need to improve a little bit. So, that is where we are.
Sure.
So, what is the import of your question?
No, I mean, when we acquired, we formed the joint venture with CIE and Mahindra came together. The first plan was to improve the efficiency of the plants that we are operating into Europe and India also. So the margins have come off, our revenues have gone up. So I'm just wondering, can we further improve on in terms of operational efficiency in existing plants?
And so the question is, can we further improve operational efficiencies, or have we reached the limit of our improvement?
Yes, that's our job. We have to improve this margin yet. There is still a lot of room, and there's a lot of, let's say, growth to do, and a lot of actions to implement. This continuous improvement is not finished, of course, and we are still some, let's say, 3-4 points below CIE's expectations. So that's our job. Some of the businesses are performing better, faster. The others are a little bit slower, but all of them need to improve their the margin. Yes. This is we will not stop until we get the minimum level that we set.
Sure. And sir, what is the capital expenditure plan for Europe and India for this year and next year?
GP?
I don't know.
GP will answer, but I think our capex guidance is always 5 to 6% of our sales. That includes both maintenance and growth capex. So that should cover.
A number here that you have in the presentation, just not off your top, is 114 crores.
It's 404 million rupees. Yes, 4 billion rupees is the amount of capex that we have for this year.
4 billion rupees, that's right.
Okay. And
crores for this calendar year, but normally it is roughly in the range of 5 to 6% of sales, which you can see unless and until there is a very big greenfield project that we do.
But this 5 to 6% for both Indian and Europe?
Yes,
both?
On a consolidated level.
Okay. And sir, what could be a tax rate one should assume for consolidated entity? I mean, our domestic, standalone tax rate is 35%. It's more than 35%. I don't know why this is high than the normal tax rate, and what could be the possible consolidated tax rate one should assume for the current year and next year?
You can take similar to what you saw in the CY17 number, which was around 30%, 30-31%.
Okay, and sir, why for domestic the tax rate is high in terms of 35?
Domestic is 35. Spain would be less. And Germany would be domestic tax rate is 35%.
Spain the tax is 27%.
Yeah.
And so last question is, what is the capacity utilization in Indian assets and European assets as a whole?
Okay, it's not an easy question because the utilization is different in each of the divisions, okay? But I would say that the utilization level right now, as an average, would be at 90%, more or less.
For both India and Europe?
Yes, as an average. In certain divisions, we still have 20-25% free capacity. Some others, like, for example, bid forge are fully booked. They are at 100%. But overall, I would say that our capacity is about, we are at 90% of utilization. And that's the reason that we are now investing this 4 billion rupees in new capacity to continue this growth. Okay, that's the basic and the rationale of our strategy.
I think I just want to add one more thing from the last call, which is that if, as Ander has pointed out, gears is growing rapidly, foundry has picked up. Okay, there is some headroom in foundry. There are different kinds of headroom. And also one of the ways to balance the capacity all around the system is that if Bilforge has got servicing its two-wheeler market and needs more capacity, there may be something lying in Chakan. So on an average, you can take the number what you're talking about. If you go granular, it does not automatically mean that there is an immediate need beyond the 4 billion rupees of capex that we've already, Ander has pointed out. You can move capacity between locations, and we are even considering how to move capacity between countries.
Sure. Sir, last question. We are organically growing so well with high rates. So, and probably we might face a capacity constraint next year. So in this context, still we are looking to acquire new assets, new companies in the near future?
Mahesh, like our M&A strategy is to fill up our gaps. We are not looking at M&A just to acquire capacity. So wherever we feel there is a gap and there is an opportunity and the valuation is something that is value accretive in ROC and ROE terms, only then we'll do it. So it is to fill strategic gaps. It is not necessarily to growth, and the strategic gaps, as you are aware, is basically diversification of our products, of our customers, of our technologies, and our geographic locations. So wherever we see that there is a good opportunity to fill this gap, we will do it.
No, Vivek, my question is that for further incremental growth, we need to add capacity everywhere in our business. So we need to invest money in that. So are we comfortable? I mean, we have to invest in probably for organic growth. So if opportunity comes, our preference will be for capex side, will be both on organic side, or we will still go all out for acquisitions?
Going all out for acquisition, I think I'm trying to go to supplement what Vikas says. All out is a wrong phrase. All out means that you're desperate. When I was a younger man, it was that the top line was vanity, the bottom line was sanity, and cash flow is reality. And if you add one more element, which is the return on equity, is finally what matters. So when you say all out for acquisitions, I'm going to only supplement what Vikas is saying. If there is a hole, if the price is right, if the ROE is good, if it is value accretive, you'll do acquisition. If something comes your way which makes sense, we'll do it. But it is not as if we have to ride on a horse and say that we are out here, a lone ranger going out for making acquisitions even if the valuation is not right. Focus is getting ROE right.
Sure, sir.
So your question with regard to whether we will choose organic growth or M&A, those decisions are purely driven by the returns. So, any organic growth capex that we also do has to deliver the returns that we have in mind. Only then those projects are taken, and that applies to even M&A.
Yeah, no, my question was that given this such a strong organic growth that you're witnessing across the geographies, are we still into, the thrust on the acquisition or filling the gap as you said, is the same as was a year back or still?
Like for example, the easiest thing is of course to grow with your customers. So that obviously, if that is the most profitable way to grow, then we'll do that. So I'm saying, I'm not saying that we are stopping our M&A strategy. We are not doing that. But our M&A strategy continues. But our organic growth is the most important thing. That it is an unarguable point. So if the organic growth gives us profitability, we'll obviously take it first.
I also want to supplement this because Andrew and I all work closely together on this. Okay. If there is an opportunity which meets all the criteria, financial criteria about being value accretive, you look at it. Okay. Sometimes you also use your intuition and judgment, and most of the times what we do is we stay away from auctions. So we do get phone calls from friends who've seen what has happened to Bill Forge, where they can be part of a larger system. They see consolidation taking place in the industry. Okay. And they ring up and say that we have confidence in CIE's style of management, we have confidence in what Mahindra CIE stands for, we have confidence in the CIE form of governance, okay, and we want to fold ourselves into your business, okay. That's the best way of trying to find inorganic growth. When it becomes auctions, okay, we don't like to participate in auctions. So when you say, will we go all out for M&A? Yes, if there is something which is sensible, yes. If it is all out only to boost the top line, no. Everything has to be on the basis of filling our gaps in terms of technology, filling our gaps in terms of geography, filling our gaps in terms of customer, and the more prospecting we do, okay, actively, the better the valuations turn out to be by staying out from auction. So you'll see a mix of the organic growth, which is a phenomenal tribute to what Ander and his team have done. Okay. You will see some inorganic growth, but it will not be at the cost of diluting the earnings or the return on equity.
Sure. Thank you so much, sir.
Thanks, Mary.
Thank you. So this is the operator. Sorry to interrupt. I would just like to check with you all if you all would want to take more questions or...
Yeah, Ander, do you have any constraints on your time, or can we extend it by 15 minutes?
Yeah, we can extend, no problem for me.
All right, so you're okay?
Yes, I'm okay. No problem.
So we can extend it by 15 minutes.
Sure. So we proceed to the next question. It's from the line of Sagar Shah from KSA Shares. Please go ahead.
Good morning, sir.
Yeah, please. Good morning. Good afternoon.
Yes, good afternoon. Yeah, actually, my question was just one, actually. I just wanted to have an idea about the company, actually, that the something like what are the something like exports and what is the something like domestic sales, actually, just to have a breakup for the MCI as a consolidated entity.
Sagar, since, we are a geographically diversified company, it is best to look at it from an India-Europe perspective.
Or maybe MCI India, if you can say.
On MCI India, roughly about, 15% would be exports, roughly. And that includes all divisions and all segments.
Okay. And for MCI Europe?
MCI Europe will be largely domestic because, the entire European business is concerned, if you supply from Germany to Spain, that I'm not considering that as exports. I'm just saying if it is going out of Europe, then and that would be in the range of 2 to 4%.
Okay. Yeah, that's it from my side. Yeah. Thank you.
Thank you. We take the next question from the line of Anand Dubey, individual investor.
Hello. Congratulations for good set of numbers. Sir, my question regarding, can you share the consolidated PAT or tax for FY18 Q1?
So I responded to earlier this question. Just take whatever has been the CY17 average rate of tax, which is about 30-31%.
Okay, sir. And my second question, how you see regarding about your margin? Will be increase or is it same level EBITDA margin for next quarter onwards?
No, of course, we would not like to make any forward-looking statement, but as Ander has pointed out repeatedly in this call, our journey of margin improvement is still ongoing. And we are quite confident that the trajectory of improvement will continue. So beyond that, let me not say anything more.
Okay. So my third question, can you share the breakup for product-wise, like bill forge, gear, stamping, and composite?
No, normally, Anand, we would not, we would request you not to look at our company in that fashion. We call ourselves a diversified company, and that is our differentiating point from many other companies. And that is the reason why, we say performance in one division complements and supplements the performance in other divisions. So therefore, we would like you to look at our company as a diversified product, technologies, end-user segments, customers, as a company which provides this diversified nature. And therefore, we urge you to look at India and Europe as a whole. India as a whole, Europe as a whole, and that is the reason why we present our results in this fashion. So that, that is what we would request you to look at.
Okay, thank you so much. Thank you so much, sir.
Yeah, thank you.
Thank you. We take the next question from the line of Sandeep Pet from Quest Investment.
Hi, good afternoon, and congratulations on a very good set of numbers. Because you mentioned that for Europe, from a longer-term perspective, we should look at growth in line with the industry. While Ander talked about consolidation which is happening on the vendor side and better quality companies are taking away market share from some of the other smaller players. So in that context, would you say that from a medium to longer term perspective also it is possible for MCI to grow at a faster pace than the industry?
This consolidation phenomena that you are seeing, we do not know how long this will continue. Of course, if this is available to us, we will partake of that opportunity. But in the medium to long term, as of now, the best way to look at it is to look at in line with market growth.
Okay. Secondly, on the India business now, along with the bill forge, I think we crossed the 15% margin, EBITDA margin this quarter. over the next couple of years, would it be fair to assume that ex-Bilforge also the India business will do about 15% kind of EBITDA margin?
I would not see why not.
Of course, that is as Ander pointed out, we are still some percentage points below what the CIE expectations are from many of our divisions. So, therefore, the expectation is that it would go up.
Okay. Yes. My question would be, or my answer would be, yes, at least we need to reach that. Okay, so that's the point. So we are working very hard to go to that point, and we have a strong action plan, a very robust action plan. I'm sure that we will be at least close to that. Okay.
Right. And lastly, over the last few months, there have been these, talks about trade wars between U.S. and China and Germany. Now, in case there is any, escalation between, say, U.S. and Europe, do we see our business getting impacted in any way? Because I assume some of the auto companies would be exporting to U.S. in a big way.
Okay. We were discussing this point yesterday in the board. Okay. My view is that in the short term, at least during all these last months, we have not had any single negative impact due to these comments, threats from one side to another side. Okay, so let's say that we did not see any impact yet. My view is that probably, and that of course this is only my personal view, okay? My view is that there will be an arrangement, an agreement between the different areas, especially I think Europe with the States, they will have a good agreement for sure. The new NAFTA agreement is also under review, and everybody thinks that it will be signed soon. So I would say that the relations will come down in the next quarters, months. Okay. The only problem I see is in China, where let's say the discussions between U.S. and China will be there, but they are not affecting to us. Okay, so just as a summary, I would say that I don't expect this will affect to us. Okay, I think that a lot of European cars are exported to the States. That is true, but also huge amount of American cars are imported to Europe. So I don't see any negative impact. No, and the risk. I would say the risk is more coming from U.S.-China war, but not. I think it will not affect to Europe and not affect to India.
Thanks, Anders. That was very helpful. Thank you.
Thank you. Well, that was the last question. I would now like to hand the floor over to the management for their closing comments.
Ladies and gentlemen, thank you for being on the call. You've discussed a number of issues about growth, assets, people, and the only thing that you haven't touched upon is how did all this come about? And for those of you who were present at how did these actually good results come about? And for those of you who were present at the shareholder meeting, my apologies for trying to say something which is repetitive. But I'd just like to close this call with a very famous saying from a very well-known industrialist, philanthropist, and so on. And there's a story about Carnegie Mellon. He was responsible for the development of railways in the U.S. He was responsible for development of steel, and he was responsible for the creation of one of the finest universities. And somebody asked him that what are you most happy about and what would you like to be remembered for? Which one of these three? And he said that please put on my grave the following epitaph, that here lies a man who had the wisdom to keep in his employ people better than himself. And on that note, I only want to say that I am privileged to be part of the team in which all of the people who are on this call and others who are not are better than me, and therefore are serving you as shareholders to the best of their ability, and will continue to do so. Thank you very much for your time.
Thank you.